Hi, I'm Malcolm Graham Wood, and I'm here at Core Finance for my CEO interview. My guest today is Andrew Knott, the CEO of Savannah Energy. Welcome back, Andrew. Great to see you again.
Thank you, Malky. Great to be on.
Now, there is so much news to talk about, and this week you're already piling on the news. And so would you start off by telling us about the full year results and what financial shape in as you record those numbers today?
Yeah, like last year was a fantastic year for our business. We grew our total revenues by 7% year on year. We grew our EBITDA by 7% year on year. Our EBITDA margin was stable in the high 70s. Our end of year cash balance was $154 million. Our production grew by 14%. Our reserves grew by 20% organically. Obviously, we announced significant acquisitions in Chad and Cameroon, which will completely transform the scale of our business. We established a renewable energy business. That renewable energy business has now signed agreements to deliver 750 megawatts up to of wind and solar projects. We extended our Niger PSC, so we get up to another 10 years of exploration activity there, and it really paves the commercial pathway for us to recommence that activity and also to do the R3 East development, which we're very excited about. We're reiterating our guidance this morning for 2022. And then I guess the last significant new announcement is Nick Beattie has been appointed as CFO of the business. He's been serving as CFO for almost the last year. Is it on an interim basis? And we're appointing three new non-executive directors to the board, Sarah Clark, Sylvie Ricard, and Jamila Farjani. All of whom have great CVs, great backgrounds, and will really be able to make a big difference to the board discussion and debate. At the same time, we announced this morning that Steve Jenkins will retire as chairman but stay on as a non-executive director, and David Jameson will retire as a non-executive director but stay with the business in the capacity of honorary president. I think the other thing to say is last year's a building block for us. There's plenty more to come in 2022, and we can talk in more detail about those sorts of things, but we expect more renewables deals, we expect more hydrocarbon deals, we expect to refinance our debt, we expect to get that Niger project moving, we expect to have new gas sales in Nigeria. There's a big opportunity there. So there's a lot going on.
Brilliant. Well, it was a stellar year, and I'm glad that you've already sort of mentioned how much it's continuing into this year. Let's tick off one or two of those boxes by going through in a bit more detail some of the really key points. If I could start off that only yesterday you signed another GSA in Nigeria with Acugas. Let's talk about that part of the business first of all, and the deals you've been cutting and the progress that company is making within the group.
Yeah, so in Nigeria is currently our sole cash generating unit. That changes when we complete the Chad Cameroon transactions. But so that's our sole source of revenue generation today. That business has $4 billion of contracted cash flows, which spread out broadly over the course of the next 16 years. And that's the sort of the minimum what we call the take or pay case. Okay, so we've grown total revenues in that business at a rate of 20% over the course of the last 5 years. That compares to the 5% long-term growth rate of revenues in the UK market. So as an example, so it's been a high growth business. And the beauty of that business is it's largely capital invested. So we have a pipeline with excess spare capacity. We have an upstream operation with spare capacity. We have, which means that when we sign up an additional customer, a substantial portion of that will drop through to the bottom line because you're not going to make a bigger pipe, et cetera, et cetera, et cetera. There's not material incremental capital investment or material extra OPEX.
And you'd expect some more deals to come on that, I imagine.
Yeah, so when we bought the business, there were 3 customers. We've now increased that number to 7. Currently, all of our customers are domestic. With what's going on in the international gas market, we will look at the opportunities to export excess volumes. We haven't got a solution for that yet, but if it was possible, it's something we'll definitely look at. But there's significant demand in the domestic market for us to continue to sell our gas, and so that's a good place to be in for us.
Excellent. Let's move over to one or two of the other parts of the portfolio, if you may. I mean, I wouldn't mind looking at you've been up to in the renewables division. You've done a lot of work on that in recent months. How does the renewables business in Africa look to you at this stage?
So look, in aggregate, we estimate there's about 310 gigawatts of renewable power in terms of the scale of the market by 2030 that Africa will need. And I think that's relatively conservative, assuming that some of the structural issues associated with building out power, so transmission grids, etc., the solutions can be found for that. And if you look at the countries in which we operate, these are the countries where the provision of additional power will make the biggest difference. So if you look at the graph and the map that I show here, I think it really explains the power of the business. So the first thing, and this is a graph I've used before, but I think it's very, very powerful. There's a very high degree of correlation and a very high R squared between GDP per capita and power consumption per capita. So put simply, for a country to grow economically and for people to develop and benefit from the quality of life benefits economic growth delivers, you need power. And then the map on the right-hand side shows that on average, only 56% of Africans have access to electricity in any form. And if you exclude the South Africa, Algeria, Egypt, then that number falls to something in the mid-40s. So really the impact that what we do will make on people's lives is tremendous in terms of living that energy. Now, the issue with energy today is that 80 to 83% of the global energy mix comes from hydrocarbons. And then if you look at the next set of graphs, I think it's tremendously powerful. On the right-hand side, you can see how long an energy transition has historically taken. So if you look at coal, crude oil, natural gas, it was all 50 to 60 years. And then the second observation on that is there wasn't displacement, not absolute displacement. What happened was that those new energy sources came to become an increasing share of the global energy mix, but they didn't completely displace. Coal's still a significant portion, unfortunately, of the global energy mix today. So I think the transition is going to take a long time. And in the meantime, people are going to need energy to improve their lives, to improve how long they live, to improve their health outcomes, all those sorts of issues. And where we are today, like we're currently on trend to effectively have similar levels of hydrocarbon demand in 2050 that we have today, when you look at what's likely to happen on the demand growth side, or what could happen on the demand growth side. And even in the net zero situation, I still believe you will have hydrocarbon consumption. And ultimately, look, it's a forecast, so there's uncertainties there. What will determine that is the rate of technological change and the rate of technological adoption, both in the renewable space, but also in the carbon mitigation space. So I think it's very, very important that, and the other thing I would say, over a third of global capex is in the oil and gas industry. So consumer preferences clearly show that energy is important, that it's required to sustain quality of life, and that today it's coming from oil and gas and hydrocarbons in general. Obviously, in the future, it will come more increasingly from renewables.
And as we've discussed a number of times before, the fossil fuel will be there through the transition, which is where you're working on it at the moment.
Yeah, so we're doing hydrocarbons and renewables, and we'll continue to do hydrocarbons and renewables. There's a fantastic opportunity set for us today to acquire assets from super majors, improve their technical efficiency by more focused management, greater levels of investment, but also to improve the carbon footprint by making investments that the current holder is not particularly motivated to make in terms of carbon mitigation, et cetera, et cetera. So I think that's really important. I think we're very good asset steward, and I think there's going to be a lot of opportunity in that space, especially in Africa.
Yeah.
And then in the renewables space, there's a fantastic opportunity. I mean, if you look at Chad, only 11% of the country currently has access to electricity. If Nigeria 55%, as examples, Niger 19%. So there's fantastic opportunities to really make a big difference. You asked about the projects that we'd already done.
Yeah, I was just going to pick up and say there are 1 or 2 outstanding deals here to complete. You mentioned Chad and Cameroon, and then I wanted to have a chat about exploration in Niger. So maybe we can touch on those 2 areas.
Yeah, no problem. So in terms of the in terms of the Chad and Cameroon acquisitions, we expect to complete them in Q3, and we're working diligently towards that. In terms of Niger, from a commercial perspective, as I said, getting the PSC reset the back end of last year was very, very important. And now we're in negotiations around the well test, and then ultimately how we're going to sell the crude that we produce. And I'm relatively hopeful that I'll be in a position to announce that over the course of the coming weeks. So both of them I'm confident on.
And presumably, I mean, you've talked about doing deals and across the whole portfolio. You've still got a fair bit on your plate in terms of future M&A, whether it be adding to gas sale agreements or renewables, or exploration, or M&A with the big corporations that you mentioned a few minutes ago, who are still looking to sell out of some parts of their African portfolios. There's a lot there, isn't there?
Yeah, you mean from an opportunity perspective? Yeah. Yeah. I mean, from a upstream M&A perspective, there's $100 billion of announced processes. Not all of that's in Africa, but it gives you, we don't need all of it to be in Africa for there to be a big opportunity set. And we've talked already about this sort of, I believe there's 310 gigawatts of opportunity in Africa for renewable energy. So yeah, there's a lot for us to go after, and a lot of the challenge around us is putting in place and building the infrastructure and the corporate systems that enable us to do what I would call being an and company, to perform in the short term and the long term, to be able to deliver the renewables and the hydrocarbons, et cetera, et cetera, et cetera. And really having those sorts of passionate people in the business that are really wanting to wake up every day and make a big difference. And that's really what I view as our biggest constraint on growth. I don't think it's the market. I don't think it's the hydrocarbon market and the renewable energy market. I think it's building that corporate infrastructure and getting the right people in place.
Well, we certainly know there's plenty to do. And you mentioned earlier on, you've made a number of board changes. I think you covered it mostly, but what with a new chairman coming through after the next AGM, Nick Beattie taking over as the CFO, and you've also got some very powerful NEDs as well. Your board is going to be quite different over the next year or two, isn't it?
Yeah, and it will continue to evolve. I think it's natural. I mean, we've grown so much as a company over the course of the past, particularly the past 2 or 3 years, that it's natural that there's that we have an evolution across the group, even just the employee headcount. I mean, I expect that by the end of the year we could have as many as 1,000 employees, which is quite a big change from where we are when we started off as sort of 4 people in London Bridge.
Yeah.
So yeah, it's been a big journey. It'll continue to be a big journey, and we'll keep on moving forward.
One of the things that I wanted to ask you, Andrew, if I may, and it's particularly one which I get a lot of feedback from, particularly from the retail, but obviously you get it from your blue chip shareholder base, is that some people describe Savannah as a growth stock. And you've always said that you wanted to pay a dividend, get something back to shareholders in due course. This looks like it's a really crux year for those sort of calls. Is it premature for me to ask you whether Savannah might become a dividend play, in the foreseeable future, or are you going to continue growing the business as fast as you have in the last year or three?
Okay, so look, I think the broad intention is that we pay the $10 million dividend that we have previously stated for next year. So not with this year's results, but with next year's results. But I think just now we're in a situation where you have a once in a generation opportunity associated with the energy transition in the renewable space and also in the hydrocarbon space. And therefore, given the returns that we hope and expect we'll be able to generate in those businesses, given the growth we think we can generate, and given the impact that we think what we're doing is actually making in the countries in which we operate, we are very, very focused on, firstly, delivering our operations safely, clearly, and secondly, growing those operations as fast a pace as is managed both in the context of a corporate infrastructure. So our focus very much is on growth, on safe operations, and then in terms of the reinvestment of the cash flows, the vast majority of our cash flows we expect will be reinvested in the business. But we have said we'll pay a dividend for next year to show a degree of discipline. What I would say is with the debt that we have, we also have enforced financial discipline through that. So very often companies pay a dividend so they don't waste the cash. And we're in any danger of wasting the cash.
Well, as we get to the end, it's been really kind of you to spend so much time with me today. Would you be able to give just a short overview of where the next 12 to 18 months might see Savannah in 12 or 18 months, Andrew, just to wrap up?
So I think on a 12 to 18 month view, I think we should be 2 or 3 times the size of where we are today. Part of that is the Chad Cameron acquisition. Part of that is the other growth opportunities that we have in the business. I think you will see a stream of additional renewable energy deals. I think you'll see several hydrocarbon acquisition deals. I think you'll see us on the hydrocarbon side deliver the upside cases that we've identified in the assets. And I think you'll see us reduce the carbon intensity of those assets as well. And on the renewable side, I think you'll see projects which are going to make a massive difference. I mean, the Niger project, up to 250 megawatts, would increase on-grid electricity supply in Niger by up to 40%. The projects in Chad have even greater, that we've announced already, have even greater impact. So I think you'll see a much bigger company in my view. And I don't think we'll have to grow in a particularly capital intensive way, or rather equity capital intensive way, because the cash generation the business will have in the future is going to be very robust.
Thank you very much for that. It's been a fantastic job that's in process at Savannah. Really appreciate you joining us again today. Thank you very much indeed for being with us, Andrew. And my name is Malcolm Graham Wood. I've been doing the CEO interview with Core Finance. My guest today has been Andrew Knott, the CEO of Savannah Energy. I look forward to meeting him again soon, and everybody else as well. Thank you very much for watching. Bye now.